Good afternoon, everyone, and welcome to this month's installation of Epic Insights. I'm Chris Colangelo, Head of Marketing for Epic, and I'll be your host for today's session. Joining us today to share some tips and best practices on how to effectively organize and manage a 401k investment plan committee is Roy Bentzen from Thornburg Investment Management. Roy's been with Thornburg since 2016 as a DCIO Specialist in the East. Before joining Thornburg, he was a retirement consultant with Allianz Global Investors and also held positions at Barron Capital, Alliance Bernstein, and Great West Retirement. He's earned the Chartered Retirement Planning Counselor designation from the College for Financial Planning and the Certified Behavioral Finance Analyst designation from the Allianz Center for Behavioral Finance. There are two companion documents for today's session, which you can download from the handouts panel on your screen. Those will also be included along with the CE credit submission form in the session follow-up recording. A quick reminder before we get started that your line will be muted throughout today's session, but if you have any questions, please enter them in the questions panel on your screen, and we will address them at the end of the session. With that, I will turn it over to Roy. Roy, take it away.
Thank you, Chris. I appreciate it. And thank you, everyone, for taking some time out of your day to join us here today. As Chris mentioned, I am Roy Bentzen with Thornburg Investment Management. For those of you who are not aware of our firm, we are an investment management shop based in Santa Fe, New Mexico, with about $50 billion in assets under management. And in addition to our investment management capabilities, we spend an enormous amount of time, energy, and resources in developing content and tools to make available to financial advisors like yourself. And here today, what we're going to do is go through one of our more popular presentations, a guide to best practices for plan investment committees. And this has been an incredibly hot topic as of late, given all the changes that the industry has faced. And you look at the different legislation that has happened over the last 10, 15 years, from QDIA to fee disclosure to most recently the fiduciary rule that has gone back and forth several times, and still a lot of uncertainty around that. Now, plan sponsors, to 401k plans as fiduciaries are obviously charged with the responsibility to make investment decisions in the best interest of plan participants. And given the importance of that job, one might think that all investment committees follow very clear guidelines to ensure they're making decisions that best serve the plan participants. And unfortunately, what we found is that's just simply not the case. In fact, it's quite surprising how many committees just lack the expertise to effectively get the job done, or they might not even be aware of what they're supposed to be doing. And that's really evidenced by the increased lawsuits and litigation that the industry has seen over the last couple of years. Just to highlight a few of the more well-known cases, you go back to 2014, Fidelity settled for about $12 million in a class action lawsuit. In 2015, Boeing settled for $57 million. In 2016, Mass Mutual, $31 million settlement. And last year, Anthem, which is an enormous plan at almost $5 billion, who actually uses Vanguard, and many people kind of think Vanguard, would be the cheapest out there, and yet even they are being sued. So this is obviously garnering more and more attention. More recently, I think this year we're seeing now a flurry of activity in the 403B space with some very prominent colleges and universities such as Princeton, Yale, MIT, and NYU, just to name a few. So this is an incredibly important topic, and it's something, again, we just want to kind of frame out so that you can help your plan sponsors make sure they're doing everything that they should be doing. So I would say kind of three big takeaways here, if I can sum it up, the presentation in its most simplest form would be: one, the importance of creating a process. Second would be documenting that process. And lastly would be monitoring on an ongoing basis and making changes when appropriate. Because most of the lawsuits and the litigation is really over the process, whether you're talking about the fees or you're talking about the investment performance. So today what we're going to kind of cover is four main topics. The first being the role the committee plays. Secondly, how do you form a committee for those plans that may not have one in place quite yet, and it's just the head of HR kind of responsible for doing everything themselves. Third, how to best structure the meetings, and then lastly, maximizing their protection from a fiduciary standpoint. So first, we're going to take a look at a few quick examples or lessons learned from others' mistakes, right? So at the top there, you see failing to amend plan design to comply with current laws in a timely fashion. That's something that should be pretty simple to do. Unfortunately, again, these HR folks, as you know, are bogged down with so many other things that they may just simply forget. You look at something, again, very simple, right? A fidelity bond. It's something that every plan should have, right? Anyone who's a homeowner probably has homeowner's insurance. It's not a great idea to own a home without that protection. The same thing applies to a 401k plan. You shouldn't have a plan in place if you don't have a fidelity bond. So those are just a couple of examples. Not going to go through all 10, of course, but they're here on the screen for you to review. I will mention over the last couple of years, the Department of Labor has increased the amount of auditors out in the field. They've added over 1,000 auditors from what I've heard, and those audits typically result in about 70% of the time in some sort of corrective action. So not only are they auditing more plans, but their hit rate is extremely high at over 70%. And I had the opportunity to meet with a former DOL auditor, and what he had shared with me is when he was operating in that capacity, the first two things that he would ask for during an audit is an investment policy statement and a fee benchmarking report. And the interesting thing about that is neither one of those are technically required by law. Yet that's what he would use to establish a baseline to see if that particular plan had a good feel and they were doing the right things. And what he found is if they had both of those documents, they were up to date, and the plan sponsor was able to articulate, right, the fees, what they're paying and why they're paying it, he would generally move on because he would assume the rest of the plan is going to be in good order. The flip side to that, of course, is if they don't have the document, they don't know what it is, or it's extremely outdated, typically you're going to go into a full-blown audit because he knows he's going to find other issues. And I've actually confirmed that with a very large RIA firm that I work with in New Jersey, where they've had 5 plans audited, and in every case, those were the first 2 items that they started with. So just something to keep in mind and something to share with your plan sponsors. So what is the role of a committee? So there's really 3 main things that they should be concerned with, right? 1, regulatory, 2, governance, and lastly, stewardship, right? And in terms of stewardship, you really want to make sure that they're operating the plan, right, with the understanding that a well-run plan helps to build participant trust and loyalty, right? And that's something that's important, and we'll talk about some examples later on in the presentation. In terms of decision-making process, of course, the primary purpose of the investment committee is to initiate and implement investment decisions, right? And ERISA has kind of defined 4 standards to help them in doing that. And you can see those there, right? 1, prudent. 2, in the sole interest of plan participants. 3, diversified to minimize the risk of large losses. And lastly, in accordance with the plan document. And again, that last one seems pretty simplistic, but if you look at the slide from a few slides back, you'll notice that is actually one of the most common mistakes, is not following the plan document because they simply don't know what is stated in those documents. The other thing that I'll mention here in terms of operating in the sole interest of the plan participants, this is something that's been challenged more and more lately because of all of the scrutiny around fees and because of the fear that that scrutiny is instilling in fiduciaries and plan sponsors. And what I mean by that is, I was talking to someone the other day, and they actually said the committee was looking for the cheapest possible fund to add to the lineup because they felt it was less likely that they would be sued. Now think about that statement, right? That is not in the best interest of the plan participant. That is actually in the best interest of the committee. They're making a decision because they think they are less likely to be sued. Now, if they were to document that, and I don't know if they did in their meeting minutes, that would be a huge red flag to any auditor coming in and doing that plan. And these conversations are becoming more and more common, and I'm sure you're seeing it as you're interacting with your clients because everyone is so fearful of the fees. Now, I've actually looked at the original 408B2 regulations that were released back in 2012. and they're 29 pages long. And I searched for how many times the word cheap, cheaper, or cheapest came up in that 29-page regulation, and it was 0. But when you search for the amount of times that the word reasonable comes up in that particular regulation, it's 55 times. So again, it's not about being the cheapest, it's about finding something that's reasonable, and most importantly, that you're able to articulate why it is what you're paying. So I just think that's an important distinction, again, based on the current environment that we're in. So failure to satisfy those 4 standards that I outlined below, or in the previous slide rather, is seen as a breach of fiduciary responsibility, and it can expose a fiduciary to personal liability, which again, many plan sponsors are simply not aware of. And that personal liability can result in things such as loss of home, personal assets, business assets. Now, in speaking with an ERISA attorney within the last couple of months, I heard that the settlement agreements that are being imposed now are becoming more and more strict. So by law, there can be a fine of up to 20% of personal assets, right? And that used to be negotiable. And what I mean by 20% is, let's say there's a plan with a missed payroll contribution. It came out to $100,000. 20% of that, of course, would be $20,000. And in the past, again, that was typically negotiable, and it'd be negotiated down to a much smaller amount. Well, the trend that this particular ERISA attorney is seeing is that max 20% fine is becoming more and more common. So just, again, something that your clients should be aware of. So here we talk about the prudent process, right? And of course, that's really just simply having the plan fiduciary, which is at the center there, working with all those other centers of influence to make sure that they're following a prudent process. There's going to be a lot of things they're simply not aware of, right? Or they just don't have the knowledge. So they need to be actively soliciting feedback and guidance from those other centers of influence, right? Whether it's you as their advisor, it's the fund vendor regarding the fund performance, third-party administrator regarding testing. So the key to this is making sure those fiduciaries are working with the key centers of influence in order to really create this prudent process, which is ultimately going to help shield them from any potential litigation or lawsuits. So what does that prudent process look like? Well, at a high level, 4 main steps, right? Analyze the information that's being gathered, making a decision based on that information, and that, of course, should be done by a majority vote among the committee. Most important step is, again, going to be the documentation, right? That decision process needs to be documented in the event that that is at some point questioned in the future, and whether it's questioned by a participant, from a lawsuit, or from an audit. And then lastly, of course, monitoring it on an ongoing basis. Now, a committee needs to establish a formal and prudent process to make investment decisions, right? And prudence is not a matter of what happened to an investment with 20/20 hindsight. It's a process, right? And a rationale that went into the decision and the subsequent monitoring. So because the prudence of an investment is not to be determined in isolation, but in the context of the overall portfolio, good record keeping becomes very important as a way to demonstrate the manner in which decisions were reached. Now, the importance of an IPS, you go back 15, 20 years ago, an investment policy statement wasn't quite as common. You look at today, I think the last number I saw in a recent study was 97% of plans have an investment policy statement. So obviously it's much more common now. But what it's ultimately going to do is really provide a framework for evaluating the investment performance, right? And protecting the sponsor from making poor decisions or decisions without any real factual basis. And one other thing to keep in mind, right, the same way most established businesses operate with some sort of written business plan, an investment committee should obviously have an investment policy statement, which helps, again, create that overarching framework and the set of guidelines that they're going to be following moving forward. uniform fiduciary contact, right, or conduct rather. Again, just about defining goals and objectives and preparing a written investment policy and making sure that process is documented. So in terms of manager search and selection, we kind of listed the 8 Ps, and we'll elaborate on some of those in some of the future slides, but basically people, process, philosophy, plans, product, progress, price, and of course, performance. So what this chart is showing here is, right, increased governance and better risk management are prompting sponsors to outsource investment services. And what you're seeing here is 85% are concerned with increased governance. And 62 of that 85% they actually view as most important. And that's no surprise, again, based on the environment that we're currently in. So allocations to other fiduciaries, 321 and 338 is obviously pretty common at this point. A lot of plan sponsors may not really know the difference, and that's something that they certainly need to consider when making their choice in what capacity they want their advisor to act in. And at a very high level, of course, 338, right, is around having discretion. 321 is simply providing advice. And it's important for plan sponsors to really understand the pros and cons of each. One of the common misconceptions out there, of course, is if they hire a 338, they're completely off the hook. And unfortunately, that's just simply not true. They are still required to monitor that 338 fiduciary and make sure that they're doing what they're supposed to be doing. And again, it's a really big misconception out there. And another trend that's taking place is a lot more of that 338 being outsourced by, a Mesero, an Envestnet, or a Morningstar. So the plan sponsors certainly have plenty of options at this point as it relates to who they want to hire and why. Now, when it comes to actually forming a committee, the first step is going to be writing the charter, right? And that's going to really lay out the purpose. It's going to lay out the roles and responsibilities for each of the members, status, membership, and then, of course, how often meetings are going to take place. Now, I was speaking with an advisor a couple months back. He actually shared a story with me on just how serious his client takes this. And what they do is, let's say they have a committee meeting scheduled for 2 p.m. on a Tuesday. Well, once 2:01 comes around, they actually lock the door. And if any of the committee members are late, they're not able to take part in that particular meeting. And again, this is just to demonstrate the importance from a fiduciary standpoint of who and why they need to be as strict as they do. So when forming a committee, right, you have to select a team of fiduciaries. You want to get that in writing, of course. The long-term effectiveness of a committee is really going to depend on the energy and dedication contributed by all the members, right? And effective committee members take the time to really learn about the unique history, mission, and resources of the organization, with a special emphasis on the background on the investment portfolio, right? And beyond that initial orientation, they will typically participate in meetings on a regular basis. They should be coming prepared, be very attentive, positive, and contribute to the overall discussion. And you really want to build strong committee leadership. There is a famous quote that a committee is a group that keeps minutes and wastes hours, right? So strong committee leadership is critical to avoiding this from happening. And of course, you want to make sure that you document and distribute the agenda. So who should you consider for inclusion into the committee? So there's certainly benefits to blending investment and non-investment professionals on the committee, right? And that's why typically you'll see senior members of HR, finance, and operation making up a committee. It just gives you kind of a different perspective. Most importantly, though, whatever the composition of that committee, continuity is really key, right? Frequent turnover is going to erode the overall knowledge of the investment program and often a group's cohesiveness and their productivity. When it comes to the amount of people, that's ideal. Well, that's kind of a moving target, and that's really going to be based on plan size. So 5 or 6 people is often considered large enough to have a diverse experience, expertise, and opinions, and small enough so everyone gets heard and understood, right? 3 people may be appropriate for a smaller organization, and I would say 9 is generally going to be viewed by some as the maximum. And you have to keep in mind that there is an inverse relationship between the size of the committee and the magnitude of each member's contribution, right? People tend to pull less hard when in a larger group. So in a smaller organization, an effective committee can sometimes be a single person if they have extensive experience with long-term investing. But regardless of the number that you feel is appropriate for a particular client, right, the most important thing, of course, is you pick an odd number so that when things go to a vote, you don't have any sort of stalemate. So retirement plan governance, something we touched on earlier, right? And what this slide is illustrating is that approximately a third of plan sponsors indicated that limited budget or resources prevented them from conducting a review, right? And that's a pretty big problem to have a third. That just simply shows they're not putting enough resources, or they're not stressing the importance that the committee really plays. And that is common in some organizations, but again, it's something that certainly needs to be addressed. So installing new members, obviously an orientation program is very important. You need to make sure that any new members that come on board have access to the plan documents and really take the time to thoroughly read through them and understand, because you don't want to be tripped up again in an audit just because somebody's simply not aware of what was written in the plan document. Acknowledgement in writing is incredibly important, right? You kind of want them to accept the position and the duties that come with it, and just keep in mind that ignorance, poor communication, or experience is not going to be an adequate legal defense. They need to be operating in a prudent manner, and that's obviously where you as the advisor can come in and help educate them and bring them up to speed. So now we're going to move on to the third component here, structuring committee meetings. So at a very high level, 3 basic steps, right? Meet, monitor, and again, the all-important documentation aspect of things. So structuring the meeting, you want to meet when there's agenda or a good reason to get together. Typically what we're seeing is 2 to 4 times per year. You certainly want to make the material available to all of the members ahead of time. Meetings should combine structure with good conversation. Common problem with a lot of committee meetings is that the agenda is just too ambitious. So the agenda should really be limited to a few key items. The bulk of the investment discussion, of course, should relate to the portfolio and decisions that need to be reached on asset allocation and manager selection and due diligence. Voting is certainly essential, right? The majority is always going to kind of decide in terms of next steps and any decisions that need to be reached. Lastly, in terms of meeting duration, typically you see an hour, maybe an hour and a half, but generally speaking, most of these meetings go about an hour. So when it comes to monitoring the investment performance, of course, you have to take a very close look at the investments and really how they're performing, not in a vacuum, but how they're performing relative to their respective benchmarks and their peer groups, right? Because they may be in a fund that's up 20%, but if the broader market or their peer group is up on average 40%, it obviously doesn't look quite as good. The flip side to that, of course, is maybe there's an investment that's down 10% and they're not really happy with it, but the peer group's down 25%. Well, in that case, it's actually looking pretty good, right? So it's just all about putting it in context for them and ensuring that they're aware of the proper benchmark and what it is, and of course, the peer group associated with that particular investment. Now, common pitfalls in monitoring investment options, if there's not a really strong investment policy statement in place, or there's simply a lack of knowledge among some of the committee members, can be a duplication in different asset classes. Maybe they have a major asset class that simply has no representation. Maybe they have, large cap value, large cap blend, but they don't have a large cap growth fund. Obviously, fund performance compared to peers, which I already kind of touched on. And then the big one, which everyone is aware of that it happens, but yet it continues to happen, is chasing last year's performance, right? And that's what people, particularly participants, get caught up in. They look at the investment menu, they look at what performed best, and they throw all their money in that. And we all kind of know how that ends when looking at the Dalbar studies. And that's really the reason why the average participant lags the broader market by anywhere from 300 to 400 basis points, because they just get in and they get out at the exact wrong times. And again, this is where you really come in and you can help educate not only the plan sponsor, but also the participants and how they should be looking at different asset allocation techniques and, their time horizon, risk tolerance, etc. So when it comes to review of the investment managers, obviously there's a number of things you want to take a look at. Any changes to the portfolio management team are, of course, going to be at the top of the list. If a fund has a 5-year track record that looks strong, but the portfolio manager just left last month, that track record from a historical standpoint might not be as relevant, of course, because now there's a new team in place. Any dramatic shifts in assets under management could be a red flag. Style drift, of course, can be an issue and might be cause to place a particular fund on a watch list based on how the investment policy statement is actually written. Changes in consistency with the stated investment objective, changes to management fees or cost increases, and then, of course, any regulatory concerns or headline risk that might be associated with a particular investment manager are all things that should be considered. So what do you include in meeting minutes? I touched on, the importance of documentation, of course. So when it comes to meeting minutes, you really want to make sure that you have the who, when, and where, right? The date, the time, and the place the meeting was held, the members who attended, and those who did not. And you certainly want to keep track of the agenda, the matters that were discussed, and any decisions that were made. And that would include, obviously, current actions that were taken or things that were tabled for a future meeting because they simply ran out of time or maybe needed to do some additional research. And you want to record each member's vote in the meeting minutes so that you have some sort of paper trail should you need to go back to it at a later date. So documenting plan metrics, what does that look like? So you can see here that about 80%, right, of plan sponsors are documenting the investment fees. And about 60% are monitoring investment manager performance. Now, they're not particularly bad numbers, but they're not great either. So 80%, or let's 75 to 80 investment fees, that means there's almost a quarter of plans out there that are not looking at their investment fees, right? And that's a serious issue. In terms of monitoring investment performance, that's obviously lower at the 61% total. So that means 40% almost of plan sponsors are not monitoring the investment's performance, which is a huge, huge issue. And that can really be, unfortunately, a detriment to the plan participants, right, who are in those particular plans because they may be in funds that are just not performing nearly as well as they should be. And maybe they should have been swapped out several years ago. And there's obviously a cost or an opportunity cost, I should say, associated with that. So when it comes to monitoring and documenting plan metrics, you can see there's really two things that stand out the most here, which are highlighted in white, right? One, the investment managers, and secondly, participation rate. So those are the two items that defined contribution plan sponsors monitor more than any other aspect of their plan. and you can see what some of those other things are, right? Such as service quality, contribution rate, fees and expenses, so on and so forth. So it's the investment managers and the participation rate that are kind of areas of top concern or priority from a plan sponsor perspective. So creating a fiduciary audit file. This is really something that every single plan should have. Unfortunately, that's just not the case, right? So what is a fiduciary audit file? Well, it's basically going to be a central repository for all of the most important documents associated with the plan, right? So the plan documents, 404C compliance, 408B2 disclosures, a copy of the fidelity bonds, any participant communications that went out, the investment policy statement, fee benchmarking reports or RFPs that were done, employee enrollment education material. So again, all of this really should be in one central location. Some plans choose to use an actual binder, right, for this, that they'll stick in a filing cabinet. Others, taking advantage of technology, maybe utilizing some sort of cloud or web-based server, and they're uploading everything digitally and electronically. I've seen cases where both the plan sponsor and their respective advisor can access that and can upload and add documents as needed. So there's no right or wrong answer as long as there's a fiduciary audit file in place. That is incredibly important. I also see some other plans actually reverse engineering the 20 steps requested in a DOL audit, right? So they'll kind of take a look at the guidelines that are posted on the DOL website and make sure that they have everything listed there. So again, this is incredibly important. This goes back to the documentation, right? Because if things are not documented, they simply don't exist. So documenting deliberations, having a process, right, is important. But if you're not documenting the activity, the analysis, the decisions that were ultimately made, you run the risk of having problems further on down the road. So again, can't stress that point enough. Everything needs to be documented. So the last section of the presentation now is really focused around maximizing protection. And you can do that through a couple of different ways, but the most common here is going to be minimizing the risk with fiduciary liability insurance, right? So it is important that plan sponsors have protection in the event of an alleged breach of ERISA, right? And lawsuits, as I mentioned earlier, are being brought up more and more by plan participants. So it's important for a fiduciary who is personally liable for plan losses resulting from a breach of fiduciary duty, as well as for breaches of other fiduciaries, to have a sound risk prevention program in place to minimize their exposure, right? And this is where fiduciary liability insurance can come in. If you look, 5-10 years back, this was not as common. It's still not extremely common, but more and more plan sponsors are starting to look into it, again, because they just want to try and insulate themselves from some of that liability. And that's essentially what fiduciary liability insurance is intended for, right? To protect fiduciaries against liabilities arising from violations of their fiduciary obligations, responsibilities, or duties under ERISA, including the selection and monitoring of investments. And it is important to note that ERISA does not require the purchase of fiduciary liability insurance. However, due to the increased frequency and the severity of the lawsuits that we're seeing by employers both large and small, this is something that is becoming more and more popular. So who pays for the insurance? Well, that's really going to vary. And keep in mind, not all insurance carriers write fiduciary insurance. And for the most part, the policy language is going to be unique to each plan. There's going to be several factors that influence the cost. Premiums are really going to vary depending on the type of the plan provisions, and how the policy is structured. So for an organization, that sponsors a standalone 401k plan with good management and a diversified menu of investment options, the cost for the insurance is typically going to be competitive and reasonable. Underfunded DB plans, converted cash balance plans, or plans with company stock, of course, are going to be higher. Other key components of fiduciary insurance costs are defense, control, and deductibles. Like any insurance policy, the deductible is a function of the ability to pay versus the likelihood of an occurrence. So plans that have confidence in their due diligence process will be willing to take on more risk and a higher deductible than those plans that do not have a prudent process in place. So again, just a couple of things to keep in mind there. And lastly, it is recommended that the company and not the plan purchases the insurance. And you can see why, right? If the insurance is purchased by the plan with plan assets, then the insurer will have recourse against the fiduciary to recover any paid losses. It's good for the plan, but not for the actual individual fiduciary. Now, there are additional types of related coverage in addition to fiduciary liability insurance, and you can see those listed there. Directors and officers insurance and an employee benefit liability insurance. And they're not going to be quite as common, but again, just kind of additional riders to have if the plan would like to take advantage of it. Other means to minimize personal liability, a plan sponsor can, right, indemnify the fiduciary, where the sponsor agrees to pay any losses or claims suffered by that said fiduciary. There can also be a written indemnification agreement, right, which is going to address issues that may arise if claims are made. And then lastly, just take this into account that indemnification is only as valuable as the sponsor's willingness and ability to pay it. So that can be a bit of a gray area. Risk management techniques, defining the roles and responsibilities are important, establishing and reviewing fiduciary governance process, right? The fee and service reviews, regulatory updates, any new services and resources, and updating fidelity bond and fiduciary insurance policy if applicable. But the best thing for plan sponsors really to do is to always be prepared as if an audit was going to be taking place tomorrow, right? This way, if they should ever find themselves in that situation, they have everything, they're prepared, and it's going to make the entire process a lot less painless. So in summary, again, two very important things you want: investment policy statement and some sort of fee benchmarking. That seems to be what's being used as a baseline in a lot of these audits, and obviously this is also something that's coming up in some of the class action lawsuits and litigation. Make sure everything is documented, the meetings, the agenda, decisions, etc. Make sure that investment performance is being benchmarked to their respective peer group and to their respective benchmarks. Fiduciary audit file, if a client doesn't have one, that should be the first thing that they start creating. That is absolutely essential. And again, that's not only for protection in the event of a lawsuit or a potential audit, but that's just good practice. It's good process, and it's going to ensure that committee members actually are up to speed on what their documents are saying and that they're getting out the necessary communication to participants and such. And planning costs, you can't stress that enough, given the environment we're in. That's really where all the focus and all the scrutiny is. And again, just keep in mind, what I mentioned earlier, that it's not about being the cheapest. That is a big misconception out there among plan sponsors that we hear all the time, right? When I look through the 29 pages from the 4AB2 regulation, cheap, again, was referenced 0 times. It's about reasonableness. And it's about the ability for a plan sponsor to, one, understand what it is they're paying, and then secondly, being able to really articulate why that is. That's really what the auditors are looking for. That's what, the litigators are looking for, et cetera. So just making sure that there is a process in place and that everything is documented. So that was really it for the presentation and the prepared comments. I'm going to turn it back over to Chris and see if we have any questions.
Excellent. Thanks, Roy. We do have a few questions that I'll throw at you. First, are you seeing more advisors taking on or acting in a 321 or 338 capacity?
So I would say, based on my conversations and observations, over the last year or so, 338 is certainly a topic of more and more conversations. More and more people are talking about it. More and more people are inquiring about it. But the reality is, I would say the implementation at this point is far less than that of a 321. 321 is just much more common, and it's just what most people are using. And again, it's not about one being better or worse, or one decision being right or wrong. It really comes down to what's most important to that particular plan and what they're looking to achieve and accomplish. But generally speaking, 321 is much more prominent.
Great. Okay. So is there one thing in particular that tends to trigger an audit? So I guess you'd say, what would you say is the biggest red flag that would trigger an audit?
So generally, it's going to be missing payroll contributions. So if payroll contributions are not done in a timely basis, that is a huge red flag for the auditors, and that can also be incredibly costly to the plan sponsor because, again, depending on how long this goes on for, and there's cases where contributions aren't just late, they're actually missed completely. And that, again, points to the importance of having a process in place and making sure if the person who's typically submitting these contributions goes away on vacation for a week, 2 weeks, a month, right? They need to make sure somebody else is familiar with that process and steps in to do it, because you can't just wait. Once you establish kind of a benchmark for how often you're submitting those contributions, you need to really adhere to that on a go-forward basis.
Excellent. And benchmarking plan fees is definitely something we hear a lot about. So I'm going to go and ask, how often would you say sponsors should be benchmarking plan fees?
So based on the conversation I had with the former DOL auditor, in terms of best practices there, he really suggested that a plan sponsor would go out and run some sort of fee benchmarking report once a year. And, that's something obviously the advisor can help in facilitating. There's several different companies out there that provide fee benchmarking reports. The two most popular are probably going to be Fiduciary benchmarks and 401k book of averages. They're the two that come up the most from what I see. I can also tell you that Thornburg actually has a licensing agreement with the 401k book of averages, and we have the ability to run completely custom reports based on plan size for the advisors that we're partnering with. So that is something, again, just based on feedback I heard from the former DOL auditor, should be done once a year. And then every 3 to 5 years, there should be something a bit more formal and extensive in terms of an actual RFP search, right, where the advisor goes out on behalf of the plan sponsor, looks at and evaluates different record-keeping partners. The plan has obviously grown over time through payroll contributions, through market growth, et cetera. And, what they had 3 to 5 years ago may or may not be appropriate based on where we're at today. So again, that's the more formal one, but annually you should just run them through a software program and just stick that in the fiduciary audit file and make sure that they're where they should be.
Excellent. Great. That's all we have for questions today. I'd like to make a quick note to everyone that over the next day or so, you will receive an email with links to a recording of today's session, a copy of the presentation, the session handouts, as well as a form to fill out for CE credit. Also, there will be instructions on where to send that for submission to get credit for today. And I also just like to thank Roy again for the insights, and thank everyone for joining us today. Have a great afternoon.
Thanks a lot, Chris.